and welcome to the May Market Update. I'm David Hobbs, and each month I share key data and insights to help educate our viewers through my perspective as a long-term, goal-oriented, and goal-focused certified financial planner. This month of May is going to be focused on some different concerns when it comes to recessions. Always where I like to start is looking at just what's happening in the market. The data you see here on your screen is as of the very end of April. This market day was significantly down, I believe 2 or 3% if my memory serves me correctly. And you can see on your slide as of the end of April, really what's happening in the market. The S&P basically down 13%, the mid-cap index down almost 17%, the global market's down 11%. Yet the long-term trend average, that 20-year return the 20-year return line being around 8-9%. This is really where we want to be able to help focus our attention. But this is always good to be able to look at what's happening with current events. Every day there's a new headline regarding recession fears, and every day you and I have to remind ourselves of the normalcy of recessions and have to embrace the inherent volatility that comes with the stock market. And we also must remind ourselves that the volatile stock market has historically been one of the best ways to get your money to work for you. And today's headlines imply the Federal Reserve is going to increase interest rates too much and will cause a recession. And we all know recessions are bad. No one likes losing money, but let me talk to you about this for a minute. You don't want high inflation. If inflation is 7%, that requires at least a 7% return on your assets just to break even. Now I'm saying that 7% return would happen in a tax-free environment because I'm not even talking about the taxes that you would potentially have to be paid on your 7% gain. Now, the cure to lowering inflation is for the Federal Reserve to cut its balance sheet and increase interest rates. Now, the market calls this process tightening, and the tightening process of lowering inflation is not going to be fun or painless, but it is going to be better than the long-term rampant inflation. And yes, I will agree that the market has felt this since the start of the year, and will probably continue to feel this Fed tightening process. Now, with that in mind, a common question I'm receiving is, shouldn't we go to cash? And my answer is always no. The market always has, and my guess is always will be volatile. Now, however, my personal view is that unless the world ends, the global economy is going to continue its progress and advance, which in turn has historically created higher stock market prices that we've all enjoyed over the years, and specifically since January of 2020, right before COVID, to last month, April 2022, all right, January 2020 to April 2022, the total return of the S&P 500 with dividend reinvested has been just under 30%. That's quite remarkable because that specifically includes the COVID recession of about 30%, as well as our current market downturn of about 13%. Now, if we do go to cash, this of course implies that we are 100% sure a recession is going to happen, which of course we just can't know, right? And additionally, since the 1950s, the S&P has risen on average 9.4%, okay, during the 12 interest rate increases. Get myself out of the way. And since the 1950s, the S&P 500 has risen an average of 9.4% during the 12 Federal Reserve interest rate increases, as we can see on this graph from Truist. And this one data point is really sure to surprise most. It certainly surprised me. And now the other item that I want to have on this is we don't want to lose sight of additional history because between January and December, the average market decline, okay, in the market is 13.7%, all right, as we can see here on this chart. 13.7%. Now, what's more, just since 1972, the S&P 500 has been cut in half 3 different times. January of 1973 to October 74, down 84%. March 2000 to October 2022, down 49%. And then October 2007 to March 2009, down 57%. However, the average market return since 1952 is a little over 11% with dividends reinvested. And so my point is that we're never going to know the future, only God does. Okay, we're never going to know the future. And unless you think the world is going to end, my encouragement is to stick with your long-term financial plan and stay invested. Now, if you're a client of mine and you aren't 100% confident in your plan, please reach out to me immediately because we need to have a conversation. And if you're not a client yet, and you want to work towards building a plan that you have confidence in, please contact me because I do want to talk through this. Now, some additional data that I want to go through each month. Each month I get asked by clients, okay, what else am I looking at? What other resources am I looking at? And this month I have 3. Last month I had 5. You can look at last month's video. But when we look at 3 different items that I'm looking at this month, the first is looking at an inflation article. This is concise and incredibly educational as far as the history of inflation. But something that I do want to highlight here is this last paragraph right here, saying that money is just another commodity. no different from petroleum, pork bellies, or pig iron. So money, like all commodities, can rise and fall in price, and depending on supply and demand. But because money is, by definition, the one commodity that is universally accepted in exchange for every other commodity, we have a special term for the fall in price of money. We call it inflation. As the price of money falls, the price of every other commodity must go up. I would heavily encourage reading this. I think it makes a lot of sense. I think it's going to educate a lot of people. Okay, another item, another data point to share is one by J.P. Morgan. Yep, this one by J.P. Morgan. And in this graphic you can see here are different reasons over the years of not to invest. Okay, you can see the very first one of Y2K, the tech bubble, September 11th, etc. The information goes on, and even as recently as the Omicron variant. But every year there seems to be some reason that people do not want to invest. Yet when we look at the cumulative total return, okay, these numbers are quite staggering. Now the last data point that I want to share is looking at the dividend payout ratios. Let's get this out of the way. Okay. Dividend payout versus stock buybacks. All right. Now companies, okay, so keep in mind that companies have a number of ways in which they can return capital to their shareholders. And two of the most popular ways in recent years are cash dividends and stock buybacks. Cash dividends, yes, they can be discretionary from the company, but most companies, once they start a dividend, they really don't want to cut it. And this is why in recent history you can see the dividend rate really didn't move much, even with COVID that happened. Okay. Now the other items, share buybacks, are really heavily discretionary. So companies can choose, pick and choose year by year. And so you can see the buyback amounts, all right, from quarter by quarter, the big drop since COVID, and then of course a heavy acceleration. So think about this. If a company is going to buy its own shares, all right, so the company is buying its own shares, what it's doing is it's reducing the number of outstanding shares, right? And if you're going to reduce the number of outstanding shares but still have the same company, this is going to increase the value of all the remaining shares that you or I may own. So ask yourself, do you think that's a good sign or bad sign? Right? For me, I think that's a really good sign. And overall, companies in the S&P 500 index are flush with cash. A lot of people don't realize this. And that cash holdings of these S&P 500 companies total $1.9 trillion. Okay, before COVID, it was $1.5 trillion. Now, a final data point on this is that the S&P 500 index companies spent about $881 billion in stock buybacks in 2021. And Goldman Sachs sees that buybacks are going to hit around $1 trillion in 2022. So again, just some different data points I'm looking at. I find all these to be interesting. I hope that you do as well. Now at closing, we of course cannot know what the market does from here, and we cannot predict when the next market downturn will occur. But what we can control is our behavior to these outside events and continue to stick with our long-term investment strategy. As always, thank you for your trust. Thanks for tuning in. If you have any questions, please reach out to me directly. Thanks. Bye.